let's talk about the next subject, which is tax anticipation notes. And basically, these are short-term notes, short-term borrowing by a town. Why might a town want to borrow money on a short-term basis? Well, it's just cover shortfalls. You know, you have taxes. You collect taxes 4 times during the year. And let's say you spend more than a quarter of your budget during a single quarter. What you're going to have? A problem with your cash flow, right? So it's just a temporary way of making sure that you don't have an issue with your cash flow. And because they are short term, they can be shown on the general fund balance sheet. They're usually 3 to 6 months, and they are notes. What's the difference between notes? Operate like treasury bills, even though treasury notes are different because they're discounted. Tax anticipation notes are discounted. So if you paid interest, you will basically receive the difference between the face value and the guys. Okay, between the face value and the interest. So take a look at this. Here, the city signs a 60-day, $300,000 tax anticipation note discounted at 6% per annum. Does everybody see the interest of $3,000? How it's calculated? 6% per annum means 3% for 6 months, or 1% for 2 months, right? That's how that number is calculated. And very straightforward. You receive the cash, you debit cash, you debit interest of $3,000, and tax anticipation notes you credit of $300,000. Anybody have any questions on this? Why are we doing this? Make sure we have cash available. Not be like California, which had to write IOUs to people, right? Because they didn't have the cash. What happens when we pay this? And again, notice this difference. You know, we're used to taking the face amount of the note and multiplying it by the rate to come up with the interest. But here it's discounted. So you're only receiving what? $297,000. So very important thing. So they operate like US Treasury bills. Okay, so here we go. At the end of the period, 60-day period, we pay off the tax anticipation notes of $300,000, and you have the cash. Why do people like to do these types of transactions? Why would a bank want to do this, or some other? Why would somebody, the financial institution, might be interested in doing this transaction? Okay. If you, the interest that's earned by the financial institution, is that tax exempt? Yes. And that's why they like that. Because the interest is tax exempt and they don't have to, so they're earning more than 6% a year, right? Based on their effective tax rate, they're earning more. And that's why banking institutions like to do that, because it's tax-free income for them. Next topic, why do we revise the budget? I think most of you know why we do this. And we've had that happen in New Jersey with the storm. Sometimes the CFO or the accounting staff might not do a good job of projecting things. And you have revisions. Remember we looked at that schedule? It had original budget and final budget. That's the reason why. So what could happen? Your revenues could go down or up. Your appropriations could go down or up, and those are the reasons. And you come to the mayor and council and you say, well, we need to revise our budget. And they say, all right, what's the revision? Well, our revenues are going to be down $30,000. So the mayor says, okay, so your revenues are going to be down. How are we going to pay for it? I think we'll reduce our appropriations by $30,000 too. And it becomes very simple, right? Basically, what would you do to bring down your estimated revenue? Since it has a debit balance, you would do what? bless you. You would credit that, and if you want to bring down your appropriations, what would you do? You would debit it because it usually has a credit balance. So those are the reasons. Yeah. Yes, it can happen, absolutely. It could be a combination, like you said. It could be a combination of revenues going up, expenditures going up. I'll tell you, most of the time what happens is they need to spend more. And need to spend more, they got to figure out a way to show more revenues. And the way they do it, a lot of places, you can't, in the middle of the year say, oh, I better send a new tax bill to people. No, you can't do that. Once the tax bill is sent out, you're done. So what do they look for? Grants and other things. And they say, okay, we're going to receive this from the federal government or the state government or something like that. Okay, so this is that discussion on, on the entry itself. Now let's talk about encumbrance. So you ordered an item on December 15th, a $1,000 item. You debited encumbrances, credited the account encumbrance outstanding. December 31st comes around. No item. What do? Two ways people handle this. One is there are some folks who like to start fresh anew, right from the new year. They close the account out at the end. They reverse the entry on December 31st. And on January 1, rebook that same entry under 2014. And the term that's used is where basically at the end of the year, your appropriation lapses, meaning your authority to spend money at the end of the year for that year lapses, so you cannot continue. Now there are other places which say, no. You know what we'll do? When we pay the expense next year, expenditure for this year, we'll just reverse the previous year's encumbrance. We won't close the account. So two ways to do this, and the book shows you both ways to do this. All right? And this is what that discussion is. Look at what's happened. So they had an encumbrance account was $8,300, and the policy is to honor all outstanding encumbrances. The final bill was $8,500. Okay? Now what I want you to do is, again, try to blank some lines out for yourself, okay? What I want you to do is, I want you to blank this line out in your brain, this one and this one. And what do you have? 8,300 and 8,300, right? Because you received the item, right? But you paid what? 8,500. 8,300 belonged to 2013, and the additional 200 goes to 2014. Now some of you might argue and say, hey, not fair. We should really charge this expenditure to 2013. And you know what? You have a point. You could have a point there. Because it was for an item which we had ordered previous year, right? So why don't we charge it? But remember, flow of financial resources. And that's the story. The amount that was booked was $8,300, and that's why we keep it that way, and that's why we have the years. Okay, so we charge the additional amount to 2014. So what if it were less? Same thing. You still reverse the same entry, but now you book expenditures of only for 2013 of $8,100. Now, this is not a major area in governments. We don't have issues with inventories. Governments don't carry a lot of inventories. 90% of the governments I know, when you buy something, inventory, you pretty much show it as an expenditure, and it's over. But there are governments which might have more inventory. So I want you to now put your commercial accounting hat on. What happens when you buy inventory? What account do you debit and what account do you credit? debit inventory and credit what? Cash, right? And then when you use it, what do? You credit the inventory and debit some expense or something, right? That's one way governments deal with this, exactly that way. And that method is based on, it's called consumption method. It's used in the government-wide statements, using perpetual inventory system. That's the consumption method. See how? Exactly that way, exactly what you just said. But then there are other governments. If I were there, I'd say, I'm not going to bother with this. First of all, I'm spending $50,000 on supplies for this year, and it might be a small amount. I'm not going to keep track of how many items, pencil, pens I have at the end of the year. I'm just going to expense them because they're not material during this year. But what governments are required to do, and a lot of governments do that, but basically what some of the governments are required to do is the following. So I bought $50,000 worth of items. I debit an expenditure account and credit cash. At the end of the year, I take account of what I have left. Okay? And basically, when I take that count, I make the falling entry. That's the purchase method that I'm talking to you about. So instead of 50, in this case, the example is 100,000. Look at what we do. We set up an account called inventory of supplies, 5,000, because that's what's left over, and fund balance, non-spendable. You can't spend supplies of 5,000. There are various categories of fund balance. Fund balance that you can spend and fund balance that you cannot spend. And why do we do that? Because if somebody came to him and said, your fund balance is $5,000, can we use that money for our appropriation? He says, no, that's unspendable fund balance because it's tied up in what? Inventories. That's why we make that distinction. But this is the other method that is used. But again, as I said, it's not a big area in governments. And this is the consumption method that you're used to, okay, where we're setting up an asset account and then doing this. Okay, and the author anticipates that many governments will shift to the consumption method. I'm not sure, but okay. Now let's take a look at the closing journal entries. And what I'm going to do is kind of show you what happens here. Let me see if I can find this in the book. So we've had all these transactions. All right, let's take a look at the closing entries. All right, first I want you to look at 23A, that journal entry. What do you see there? Do you see something? Forget about the amounts for a moment. When you recorded the budget initially, isn't this entry a reverse of the original entry? Remember the original entry, you did what? Debit estimated revenue, debited budgetary fund balance, credited this. So apparently these numbers are a little different because we added to the budget and subtracted. That's why they're not exactly the same that were at the start. So what do you see? The exact opposite entry that was used to record the budget. If you had no revision to the budget at all during the year, what would you have? Exactly the opposite. Why? Because you need to close the accounts out. The only way to close the accounts out is by doing what? By doing exactly the opposite. We're closing out the budgetary accounts. And then it becomes pretty simple. Revenue accounts have what? A credit balance. To close an account with a credit balance, what would you do? Debit it, right? Because this is a closing entry. No different than an income statement closing. Closed actual revenues of $4,500,000, Expenditures, we designated this, and we have a debit of what? Unassigned 242,760. So how much of the fund balance did we use during the year? 242. What was the original balance we had thought? I don't remember now, the original entry itself, but that was the, that's what we end up. And that's the closing entry. Notice one thing. Where do things get close to? Fund balance is like your retained earnings. Think about fund balance like your retained earnings. It's not, but think about it that way. And you can debit or credit retained earnings depending on how you did, right, during the year, right? And this is an interesting thing. The fund balance comes in a variety of flavors. You might say, what does he mean by variety of flavors? Well, we had two major flavors, right? Unspendable and spendable. Within the spendable category, there are several different types of fund balance. There's fund balance that you can play around with. There's fund balance you cannot touch. And and we'll go into this in chapter 9. Basically what happens is certain governments might say that by law or by statute, you are required to keep X amount of fund balance for this reason, committed or restricted for that reason. And the unassigned fund balance is fund balance which can be used anywhere. Assigned fund balance is your CFO who says, this is my wish list. I want to keep this money to buy some computer stuff and all this. I don't want people to be touching that. So there are levels of restriction, and we'll go into that when we talk about chapter. But this is what they're doing. They're taking the unassigned fund balance and distributing it between these two categories. Maybe there was a police car they needed for public safety, maybe some improvements to the field that they have, okay, that's needed, okay, so that's what they're doing. They're transferring it from what? Unassigned, because fund balance, the normal balance is what? Usually debit or credit. Fund balance with retained earnings, debit or credit balance. That's it. Fund balance is debit or credit? Credit, yeah. Because asset equals liabilities plus fund balance. All right, now what we're going to do is, so that's something to, please do take a look at it because I did go through this rather quickly. Special revenue accounting, I don't think there's anything too earth-shattering here. So what's the difference between general fund and special revenue fund? Special revenue fund is set up for what? A specific purpose, right? And what are those specific purposes? You know, fuel taxes, federal grant to operate, and others, right? Everything is exactly the same. By the way, once again, how many different types of governmental funds you know? General fund, special revenue fund, what else? Debt service, permanent, and one more, capital projects, right? Those are the 5 types of governmental funds okay? So here's an example of a grant that's received in cash from the federal government to operate a counseling program for troubled youths, has been earned by meeting the requirements related to service recipient and you report it as deferred revenue. Let's take a look at this. Federal government comes in and says, I want you to use this $100,000 for this purpose, but you need to do something, but sends you a check. Doesn't usually happen. Sends you a check. Is that revenue? Not until you've done what they've asked you to do. Then you can book it as revenue. So where do you park this money? Well, first you take the cash and say thank you, and then what do? You credit a deferred revenue account. Because a deferred revenue account, if you remember your accounting, is a what? A liability account, right? Then we go ahead and spend some money for this youth counseling program, spend $75,000. We spend $75,000, and what do we do at the same time? Okay, now we deserve that money. And we get what? Debit the deferred revenues and credit the real revenue account. So how much more do we have? $25,000 still to be earned. This is how grants operate. Okay? One way that grants operate. And really the financial statements, if you remember, and I'd like you to keep on, whenever things get a little rusty, just those financial statements in chapter 2 at the end, which show you the way things are formatted. In order for something to have its own separate column, what must it be? A major fund, right? So, but does it have to be a major fund for you to show it? No. So when you look through that CAFR, you might find special revenue funds, but nowhere on the financial statements. They'll be in the combining statements, the lesser funds, okay? It's because it's not a major fund, okay? So now let's talk about, now this is a lot of, this is something that we're going to be dealing from this point on, which is these types of transaction. Okay. In governments, we come across two types of transactions: exchange and non-exchange transactions. Exchange transactions occurs when equal value goes between two parties. So I am the water department for the town, and in order for you to use the water, I send you a bill. You're using the water. The more you use that, the more you'll get billed. That's an exchange transaction. The benefit is proportional to what? The amount that's charged, right? Non-exchange transaction doesn't work that way. Let me give you an example of non-exchange transaction. Property taxes. So you are paying, you've got $1 million home in a town. You're very upset because you're paying all these taxes. And you have no kids. Not far from you is a home which is worth half of what your home is worth. They have 5 kids going into school. They are paying taxes on the value, not on the number of kids that are going to school, right? That's your non-exchange transaction, because there's nothing of comparable value that is being traded across, okay? So let's take a look at an internal exchange transaction between a city waters department and general fund, okay? Let me first there's a lot of stuff here, and let me just put this in context for you, okay? There are transactions that can occur between government units themselves. When it's within the governmental fund area, it's called Intra. If it's between the governmental funds and proprietary funds, it's called what? Inter. So don't get confused. Intra as opposed to inter. And we'll look at that now. interfund transactions, interfund loans, interfund transfers. Okay. Loan is obviously something flowing from one entity to another where you don't, what do you expect? Repayment, right? A transfer is a non-reciprocal activity in which there's no intention of repayment. And in financial statements, you have to clarify whether it's an interfund loan and interfund transfer. Sometimes what might happen is a government might want to set up an internal service fund. But how they go about setting this up if there's no money? So the government does what? Loans the internal service fund some money to buy stuff. So that becomes what? An interfund loan. Sometimes, as in the case of New Jersey Transit cannot cover all its costs from the fares that it charges. What would that be? An interfund loan from the state or interfund transfer? A transfer, because what? They don't expect anything back, right? That's an example of that. So again, this talks about the different types of transactions, and you can read about this, but what you need to do is you need to keep in mind two things. One, is the transaction occurring between the governmental funds or between the government funds and proprietary funds? That's the first question. Is it occurring between the governmental funds or between the governmental funds and the proprietary fund? The second thing that you need to keep in mind is it a loan or is it just a transfer? So those are the two things I want you to remember. And these are that's the terminology that's used. I think we talked about permanent funds. There's a brief introduction here about permanent fund, and the most famous permanent fund is what? State of Alaska, right? Keeps on paying dividends. Do you ever use the principal? No. It's just the earnings that are spent. Unfortunately, not many states have that luxury. But there are some journal entries I'd like you to take a look at, but it's pretty straightforward. So tell me one thing. You know the journal entries that I showed you for expenditures and encumbrances and budgets? Could I have the same journal entries for the Special Revenue Fund? Yes. It's what? It's a governmental fund. Exactly the same journal entries. Would I have the same journal entries for business type activities? No, because that's based on what? Accrual basis. The governmental funds are based on modified accrual basis. So whenever you think about encumbrance accounting, you always ask yourself, all right, is this a governmental fund or it's not? If it is a governmental fund, you're good with budgets, you're good with encumbrances, you're good. Okay? But if it's not a governmental fund, in terms of using modified accrual basis, you'll have to, you don't need to worry about it. And I talked to you about exchange transaction. And so why do we worry about exchange and non-exchange and all these transactions? Remember, one of the critical things in accounting, and this is why people get in trouble, is when to recognize revenues and expenses. What do companies like to do? CFOs. If it was up to them, they would push up the revenues, right? And defer what? Expenses. That's called balance sheet, dressing, whatever. They'll try to do what they can, right? Same problem as we find in government, but not to that extent. So there are specific rules. GASB has specific rules on how you should recognize these transactions, and you have to stick with those. You don't have the flexibility. like California did, where they said, all right, you know what we're going to do? The last pay date is December 31st. Let's pay them on January 1st or January 2nd. You know, crazy things like that. And they do happen, by the way, in some places. So we don't want those types of things happening. So this is what we have, and these are examples of non-exchange transactions. Now let me explain to you what this is. Let me see if I... So when do we recognize revenues under exchange transaction? When the transaction occurs, right? Very simple. All right. Non-exchange transaction, there are several different types of non-exchange transaction. And in this case, the revenue recognition depends on time requirements, the period in which resources are required to be used. In some cases, it can be delayed until the requirements are met. Let me give you more specifically the example of how this works. At the end of the chapter, there's an appendix, which is not easy reading, but you have to understand it. Okay? In that appendix, these are the 4 types of non-exchange transactions that you will see. What, again, non-exchange means what? There's nothing that you're getting back, right? There's no value being exchanged. Derived tax revenues, income and sales tax. You say, what does it mean by derived sales taxes? Well, think about the word derived. What does the word derived mean? Derived from something, right? So in the case of sales tax, how is the sales tax derived from? From the sale. Income tax is derived from your income. That's why the title, derived sales tax. Okay. Next category, imposed non-exchange revenue. Property taxes and fines and penalties. I explained to you why this is a non-exchange transaction. But why the word imposed? Do you have any flexibility to say, I don't feel like paying this? Right? You've got to do it, right? And that's why it's called what? For that reason, it's imposed, right? You don't have the option. Government mandated non-exchange transactions, okay? Certain services funded by a higher level of government. And then look at the difference between these two terms, mandated and voluntary. I want you to think about this. One is, whether you like it or not, you're going to take this money. When might that happen? Why would a government say, I don't want this, and they still have to do it? There could be certain programs, exactly. And you know about these health exchanges, but here some states have opted out. For instance, the federal food stamp program. So here they're mandated. In this case, you have the ability to say yes or no. So there are 2 types of grants that we're dealing with, right? Okay. So now let's take a look at the revenue recognition criteria. We talked about the 4 different things. How do we recognize the revenues? Okay. For derived tax revenues, you recognize it in the period in which the underlying exchange occurs. Sales occurs or income is earned. Well, that sounds obvious. Okay. So if it was earned during a period, you recognize it as such. In the case of the second one, recognize when there is an enforceable legal claim or in the period for which levied in the case of property taxes. Okay. What that means is, if you're going to pay property taxes for next year, can you count on those revenues this year? Do you have a legal claim to those taxes now? No. When would you have a legal claim to them? When next year comes around. And that's what that means. You recognize it when there is a claim, a legal claim on those taxes. Government mandated non-exchange transaction, recognize when all eligibility requirements have been met. If cash is received before then, you use a deferred revenue, account is credited. Remember I said to you again, you can get grants again in several flavors. There is the one which says, all right, I'm going to give you money for this purpose, but you'll get the check when you spend the money first, right? That's what a reimbursement grant, right? When can you recognize the revenue for that? When you spent the money, right? There's the other one which says, I'm going to pay you $100,000 now, but it's really for next year. And for whatever reason you might want to use it. So what do? There is a timing issue that comes. So what do? You show it as deferred revenue in this year, and next year it becomes what? Real revenue, right? The third case would be where I say that, okay, I'm going to give you this money for this purpose and for this period. So now I have to meet what? Both those requirements instead of just a blank check. So, you know, as I said, when you read this, the stuff might seem really complicated, but think about it from a really very common sense way. Just don't even, if you don't look at it and just put your regular accounting hat and say to yourself, how would I recognize this revenue? If you don't feel comfortable with the way you recognize revenue, you know you're wrong. I mean, you're right. You know, you're right that it is not being done correctly. Okay. And why does GASB do this? Because GASB doesn't want state and local governments to play around with their books. Remember the word accountability? That's the reason. So they're very strict. And you might say, who's checking up on this anyway? Our auditor friends. They're going to go test these transactions. And they're going to check to see how you book revenue, especially on grants. They go after the grants first because they don't want you to be playing any game. Okay. And we'll come to the audit section, which is quite interesting, actually. Interim financial reporting. Is GASB's reporting internally focused, externally focused, or both? Externally focused only. Which means with interim reporting, you can do the statements as you want. Of course, you want statements which make sense, but you can pick your format. You don't have to prepare government-wide statements because GASB addresses external reporting. And many, many organizations don't do government-wide statements for the government-wide reports. They don't do it for interim purposes, for internal purposes. First of all, because of the pain in converting modified to accrual, and two, because they're not being published outside. Okay? So what we're going to do now, by the way, before we, any questions before we go to the next piece here? Let's see, I have still a couple of minutes left. Should we do some more clicker questions? No? All right. You guys are tired. Okay. But let's take a look at what I want you to do is I'm going to go in and by the way, I did have a note on one of the assignments I was looking at. Let me do that first. Okay, you know, I gave you the assignments for chapter 3 and 4. And there is one question, which is problem 3.7. Just make a note of this, problem 3.7. And in problem 3.7, you're supposed to make some journal entries and show the revenue and appropriations ledger. All I want you to do is just do the journal entries and skip the revenue and appropriations ledger. And you'll see when you look at it what I mean. It's just a lot of wasted time, a lot of typing. It's, as long as you get the journal entries, we're good. Okay? Yeah, that will reduce tremendously the work on that problem. 3.7. Okay? All right. The other thing is, let's take a look at some real questions here. See how much we know. By the way, any questions so far? Everybody still with me? Okay. What I'm going to do is I'm going to go to one of the problems. Just so that you can get a flavor of no, what I'm saying is you don't have to, with the journal entries, make the show the transactions as they appear in the revenue and the appropriations ledger. You know the breakdown in each of the journal entries? You don't have to do that. That's the only question, I think, which requires you to do that. 3.7. Okay? What I'm going to do is, let me just do one thing, which is, I'll show you an example here, okay? All right. All right, this is the question I want you to just take a look at. This is on page 160. It's a real problem, and it shows you amounts of purchase order and what was received. So just follow this along with me. How much did we order? 567. How much were the things finally? 569, right? Okay. All right. And let's see what it's asking us to do. So it says, prepare journal entries to record the issuance of purchase order. And see where it says, in addition, show subsidiary details for the encumbrance ledger. You don't have to do that. Okay. So let's take a look at how this journal entry shows up. All right. As I said, we're not going to be concerned about this. The encumbrance, just forget about this, okay? Just the journal entry itself. What was the amount that we ordered? 567.9. Everybody see this? Debit and credit. What's the second entry after that? We got 569,850, right? But what do you see now? You see the reversal of the original amount, right? This was the original. You see this reversal, right? And what do you book? The amount of the, right? Is everybody with me? Do you see that? Okay. So we are reversing this, and this is what we're coming up with. And of course, we go ahead and pay this of 569,850. So you basically credit cash and debit the payable account. Now this last question is, does the fact that the actual cost of goods received during the year exceeded the estimated cost when ordered suggest a budgetary or management problem? No. No. Prices often change, and that's what we have. Now I'm going to show you on page 162. So that's the answer to that one. Okay, this is, they want you to prepare some closing entries. Which are the budgetary accounts that get closed? Appropriations, estimated revenue, encumbrance, expenditures, other financing revenues, and budgetary fund balance. Let's take a look at this. So what they want us to do is prepare the journal entries for this, and I want you to just, so that you get an idea of how this is done, take a look at this. There were supplies of, it says, of $12,000 that increased from the previous year, so we debit 12,000, credit the non-spendable, and look at the same exact way we had done previously of closing the general fund accounts. The reverse of where we started, right? Anybody not understand that? Okay. The only complication is this. Their supplies increased by 12,000. So what do we have to do? Debit some kind of a asset account, right? And on the credit side, we got to find a credit account. So we put it in fund balance, non-spendable. Okay, I just got the message. Non-spendable inventory of supplies. Okay.